Hello, my name is Brenton Harrison, and we're here today to talk about something called an exchange traded fund, or an ETF. We'll cover what they are, how they work, and how to decide whether they're a good fit for your portfolio. Let's get started. I'll tell you, even as an advisor, it's tough sometimes to keep up with all of the investment terminology that comes your way. You've got terms like standard deviation, alpha, beta, and all of these things work together to help you evaluate things like stocks and bonds and mutual funds. Most people may feel they have a basic understanding of terminology around things like stocks and bonds and mutual funds. And in past years, you've seen the increased exposure of a term called exchange traded funds, or ETFs. But what is an ETF and how does it work? How does it compare to a stock or a bond or a mutual fund? What I thought we would do is we would pull in clips from an old video where we talked about the basics of these investment types and then compare them at the end to exchange traded funds so you'll understand how they work, how they could be a fit in your portfolio, and also why they have increased in popularity over the past few years. A bond is when an investor loans money to an entity for a defined period of time at a fixed or variable interest rate. If you're buying a bond, then you are the person who is loaning the money. And if you are issuing a bond, then you are the entity that is receiving those bond proceeds to finance a certain venture. And when you're in the marketplace as a consumer, two of the things that can help determine the terms that you're offered is A, the length of time that your money is going to be tied up, and B, the credit quality of the entity to which you're lending the money. For example, if you are buying a U.S. government bond, it is unlikely that the U.S. government cannot pay back that debt, hopefully. And in exchange for the fact that that is a low risk, you cannot expect a high rate of return on your investment. Conversely, if you lend money to an entity that is not stable, you might expect a higher rate of return to compensate you for that additional risk that you're taking. Next, we have stocks. And when you buy stocks, instead of loaning money, you are instead purchasing ownership in a company by acquiring shares. Let's say I have a company that's worth $100 and I issue 10 shares of stock at $10 a piece. If you invest $50, then you can buy 50% of my shares, 5 shares. And if the value of my organization goes to $200, then the value of your shares would double, even though you haven't purchased more of them. However, if the value of my company goes down, so does the value of your shares, and this is how people lose or make money when purchasing stocks. Lastly, we have mutual funds. And mutual funds, when you invest in these, unlike stocks and bonds, you are actually putting money into a pool, and that money is invested in a basket of securities, and those securities could include stocks and bonds. Some mutual funds are professionally managed, and others are really looking to find a certain sector or an index of the market that they're following closely. And this is something that a lot of consumers do to diversify their investments because unlike a single stock or bond where you're loaning or buying into one entity, a mutual fund could have dozens of stocks and bonds, which will hopefully spread out your risk. And it's really hard sometimes to figure out whether a mutual fund is right for you. So to help with that, they issue a prospectus. And a prospectus is a document that tells you the fees that are in that investment, the holdings that are in that investment, and the philosophy of that fund so you can decide if it's a fit or whether you need to keep looking. Now that we've covered some of the basic investment types, we can reintroduce the term exchange traded funds, or ETFs, and we can talk about the characteristics that they share with stocks, bonds, and mutual funds. Just like a mutual fund, ETFs can invest in a broad range of stocks and bonds and even other funds. And the goal of these exchange traded funds is to hopefully spread out and diversify the risk. It's not to say that there's no risk, but the hope is that by investing in more companies, investing in more instruments, that you can make sure that in the long run, you have the best opportunity for a less volatile, positive return over time. Now, here's where the characteristics of an ETF are more similar to a stock and a bond than they are a mutual fund. While the investment makeup of a mutual fund is similar to that of an ETF, mutual funds actually cannot be purchased during trading hours. If I try to buy into a mutual fund at 12 Central Time, which is during trading hours, whatever I try to purchase now will not actually be finalized until the trading floor has closed. So I don't have as much control over the price that I pay in some instances because I might try to purchase at noon when it's a certain price, but by the end of trading hours, that mutual fund has gone to a different price. ETFs, however, can be traded throughout the day, even when the stock floor is open, just like you see with stocks and bonds. And the hope is that by being able to take advantage of trading hours, you have more control over what you pay in terms of the share price of an ETF than you would with that of a mutual fund. ETFs can also represent a more cost-effective way for investors to dip their toe into the market. Many mutual funds and index funds have a minimum initial contribution, a minimum amount that you have to invest before you can enter into that fund. Now, there may be funds that have a $500 or $1,000 minimum initial contribution, but there are others out there that have minimum contributions as high as $3,000. Exchange traded funds can be purchased for the price of one share of an ETF, which may be as low as $50. So it's a much more palatable entry point for some investors. It's worth noting that whichever type of fund in which you invest, be it a mutual fund or an index fund or an ETF, they're all going to have some cost of operation. They're going to have an expense that they pass on to their investors that just allows them to keep the lights on, for lack of a better phrase. But what you find with ETFs is that the expense ratio they charge is often more cost effective than what you'd find with a comparable mutual fund or an index fund with a similar investment allocation. Now, one downside to the fact that you can buy into an ETF and trade out of an ETF during stock trading hours is that you can't make regular automatic contributions into these funds in the way that you can with a mutual fund and an index fund. But some of these things, in terms of the cons, are outweighed by the pros for an investor who's looking to be able to move more quickly in and out of a position in an ETF. Whereas with a mutual fund or an index fund, there's less control over the price they pay and when they can make those distributions or contributions to these funds. So why are ETFs so popular? Well, in this internet age, you're finding out that technology brings lower cost and opens up opportunities for investors who may want to do some things in the marketplace that they would have been priced out of in years past. Whereas 20 years ago, an investor might have had to have $100,000 to have access to a platform where an advisor or a management company would look at their account and put together a portfolio that meets their needs. Now, with the age of technology, you can find that same level of customization for as low as $500 or $1,000. Specifically, in the past decade or so, we've seen the rise of what's called robo-advisors. And these are essentially digital platforms where computers use algorithms to determine what type of investments they should hold for your risk tolerance. If you tell them, I have an account that I want to be able to access in 10 years, and I'm worried about taxes, and I am not that aggressive an investor, you could have a computer algorithm from a robo-advisor set up the type of customized portfolio that fits your needs at a fraction of the cost that you might pay to go to an actual human advisor like you would have had to in years past. Now, obviously, as an investment advisor, that's a human being and not a robot. There are obviously things that I think are worth paying for. And there are times when I think that a robo-advisor may not offer services that are as comprehensive as what you might need given your financial situation. But there are some people out there who are truly just looking for low-cost advice that's quality. And a typical relationship with an advisor like myself might mean that I charge you, say, 1% of assets under my management, and that comes with other services, but the pure investment component of it is a 1% fee. And each fund and each investment in which we invest inside of that account might charge their own fees as well. Conversely, a robo-advisor might charge that same type of account 0.25% as an investment fee. And they also offer some planning services or even banking services that certain investors see as a good fit to their portfolio. Now, robo-advisors often invest exclusively in exchange-traded funds because of their low-cost structure and their ability to be traded throughout the trading day. These robo-advisors utilize these ETFs hoping to either mitigate losses if the market's going down or take advantage of an upswing in the market by having these diversified accounts that can be traded with frequency as opposed to having to wait until the end of the trade day to take advantage of the opportunity. Make no mistake, as I said, as an advisor, I think there are plenty times where it's worth paying for human advice for the things in which you're investing. But the first thing that you want to make sure you know, regardless of who's managing your money, is how that account works. You want to know in which you're invested so that that knowledge gives you the ability to measure and evaluate that person or that company objectively. There are so many different platforms out there for people who have an interest in investing. And ETFs are just one investment tool that have increased in popularity over the past few years. By understanding how these tools work, you can start to educate yourself and build a plan for the right mix in your portfolio.